Welcome back to Advanced Accounting. In this class, we're going to cover Chapter 1 of your textbook, Equity Methods of Accounting for Investments. First, let's start from a recap from your intermediate financial accounting. In intermediate financial accounting, we talked about accounting for equity investments. Does anyone still remember what are equity investments? So here's the definition of an equity investment. Equity investments are purchases a firm makes on the equity securities of other firms. And here are some examples. So the first one is Berkshire Hathaway, for example, purchased 75 million of Apple stock. This is an equity investment that Berkshire Hathaway made on Apple stocks. And then Tesla purchased all Solar City stock for 2.6 billion. This is an equity investment made by Tesla. Google purchased all YouTube stocks for 1.65 billion, and this is an equity investment that Google made. So what are the methods to account for equity investments? You probably still remember that in the previous accounting class, we talked about there are 4 methods to account for equity investments. The first is called fair value method, and we also have cost method, equity method, and the last one is consolidation. So what are the differences among these methods? These methods differ in 2 ways. First, they differ in the situations that they apply to. And then secondly, they also differ in the specific accounting treatment that should be used under each representative methods. So first, how are the 4 methods differ in their applicable situations? In general, which method we choose depends on the degree of influence the investor has over investee. So the degree of influence an investor can have significant influence over an investee, or it can have control over the investee. If an investor has significant influence over an investee but no control over investee, then we use the equity method. If an investor has control over an investee, we use consolidation. And if an investor has neither significant influence nor control over an investee, we use the fair value or the cost method. So fair value and the cost methods, those 2 methods are used when investor has neither significant influence nor control over the investee. And that is usually when an investor has less than 20% of the voting stock of the investee. And specifically, cost method is used when fair value is not readily determinable. And the equity method is used when investor can significantly influence investee's decisions. And that is usually when investor has between 20% to 50% of the voting stock of the investee. And lastly, consolidation is used when investor controls all of investee's entire decision-making process. And that is usually when investor has more than 50% of the voting stock of the investee. So those are different situations when different methods are used. And then let's look at how are the 4 methods differ in the different accounting treatment that applies under different methods. So first of all, fair value method and the cost method. Those 2 methods, we recognize investors' share of investees' dividend as income. And then specifically under the fair value method, we recognize the change in fair value as income. And under the cost method, we periodically check for impairment, and we can recognize observable price change for similar investment. So in this later part of today's class, we're going to talk in more depth about the fair value method, but we are just not going to talk so much about the cost method. And then the third one is the equity method. In the equity method, we recognize investors' share of investee dividend as reduction in investment. We also recognize investors' share of investee net income as an increase in investment as well as increase in income. What does this mean? We're going to also talk more in depth about the accounting treatment for the equity method later in today's class. The last one is consolidation. Under consolidation, we report a single set of financial statement for external reporting purpose with all assets, liability, revenue, expense from both investor and the investee brought together. And we're going to spend most of the rest of the semester talk about how to do consolidation. So there will be enough talking about this part later in the semester.